on this Forex Basic Class Series 1.0 by Top Forex Academy. And guess what? We are heading to a very interesting topic that will set your Forex trading on a very grounded footing and give you a deeper understanding of what happens in the market, and you will be able to have a reason for making wise decisions on any trade you take. And this topic is technical analysis. We're going to be looking at technical analysis part A, during which we will be deciphering different candlesticks. This topic would help you to have a grip of Forex trading, and you'll be able to trade without support of anyone. You'll become very strong in Forex trading if you can stay focused on technical analysis. This is a topic you need to go over and over again. So it is very good for those that needs refresher courses. Even though you've been trading for a while, you could come here and take refresher courses on technical analysis. And also, if you were a newbie a few weeks ago, but now you're here doing technical analysis, this is a groundbreaking opportunity for you to delve into Forex trading as a professional. I hope you're ready to dive in with me. Make sure you follow through this video to the end. There will be great tips that I'll be dropping in the course of this video for you to really be a full-time Forex trader, or you want to do it as a part-time, whichever one fits into your schedule. I want to tell you, with technical analysis, you are good to go anytime, any day. So in this lesson, we will cover technical analysis, which is the study of price movements and chart patterns to identify future price movements. Technical analysis rely on charts and technical indicators to identify trends and trade opportunities. There are three main types of charts used in technical analysis: line charts, bar charts, and candlestick charts. But in this lesson, we'll be focusing more on candlestick charts, and we will hope that you will follow through. And after this part A, we'll be looking into chart patterns, so you can learn more about chart patterns and how they look like. But for this lesson, our focus will be on candlestick charts. Line charts are the simplest form, and they show the closing price for a currency pair over a period of time. Bar charts often show open, high, low, and price and close price for a currency pair, while candlestick charts provide a visual representation of price movements with candlesticks, bodies, and wicks. This gives us more information, and with this, we are able to make better decisions. Technical indicators such as moving averages, oscillators, and trend lines can also be used to identify trends and potential trading opportunities. Moving averages are used to identify the directions of trend, while oscillators such as relative strength index RSI can be used to identify overbought and oversold conditions. Trend lines are used to identify key levels of supports and resistance. So it's important for you to learn how to draw trend lines. They are just horizontal lines most of the time that you draw on the bottom to represent supports. As you have seen during understanding Forex basics, you will see that some support line were drawn and also some resistance line were drawn. Trend lines are used to identify key levels of support and resistance. Support and resistance are just horizontal lines that are drawn below a price level and above a price level. Other times, you could have other lines being drawn at a specific angle to show other types of trends for you to see what is going on in the markets. As we see in the previous lessons, understanding Forex basics, you saw that there were support lines and resistance lines. Now we're going to be looking at them in details and even see how you can draw your own support and resistance. Right on with me. Here we have white candlesticks or green candlesticks. This indicates uptrends. So you can see in this place, this is a so you can see in this picture, we have green candlesticks or sometimes whites. As you can see in this picture, we have a green candlesticks, and sometimes it can be drawn with white color, right? Either white or green, they indicate uptrends. They are called bullish candle. Then when you see something like this, red candles or black candles, they are called downtrends. They indicate bearish candles. But what is common to both is that this bullish and this bullish and this bearish candle have a body. You can see they have a body, and also let's focus on the bullish candle. You can see that it has a body, okay, and it has a close and it has a open. Now it opened here and moved up. That's why it's called bullish, and it closes here. But look at this bearish candle. It opens up and closes down here. That's why it's bearish. Both of them also have another thing in common. They both have wicks. These are wicks. Wicks are just showing you, like for bullish, it's showing you the high of the day and the low of the day. And also, like for bullish, it's showing you the high of that candle in that time frame, and also it's showing you the low of that candle in that time frame. Also, this is showing you the low and the high. But for you to understand this, if the candle is bearish, the high, once it touches the high, it keeps coming down. But for bullish candle, once it touches the low, it keeps what? Going up. So if you can understand where your low is or where your low of the day is, and you are looking at an uptrend in your charts, you may be considering to go and take it from where the low of the day starts, because the market will surely repeat itself and surely repeats what has happened before. In a situation where you have a candle showing you that the open and the close are the same points, then we call that doji. That is not the same for this bearish, and for this bullish candle. They have different opens and different close. But for doji, you have open and close at the same point. Despite that speed, Despite their speed and accuracy in trend predictions, candlestick patterns are often reliable when used in conjunction with other types of technical analysis. That is why we call this topic technical analysis, plural, with E. So that means if you are treating one technical analysis, which is candlestick, you should also try to understand other technical analysis, which are chart patterns or moving average or RSI, to corroborate what you're seeing in one analysis. And that's if you have another one to corroborate it, it gives you a confidence. And that confidence gives you a level of confidence for you to confirm what you're seeing in the market before taking your trade. I hope you're following. Now, using any type of technical analysis with another for confirmation is called a confluence, like I've said. So now let's look at this. We have types of candlestick patterns. So we want to look at the bullish candlestick patterns. Sometimes after a long decline in the market, bullish patterns will emerge and indicate a reversal. The signal to investors that it may be worthwhile to start a long position in anticipation of a price increase. Now, look at this very place. This is what we are saying. You can see that after a long, now you can see in this place, in these charts, okay, that sometimes, like it's seen in these charts, after a prolonged decline in the markets, Okay, a bullish pattern will emerge, which signals a reversal, and then this signals to investors that it may be worthwhile to start a long position in anticipation of a price increase, like Bitcoin just did here, came right down, and then we have a bullish reversal here, and then we have some little break of structure, comes down, it's not making any lower low anymore. Rather, it's making a new high, and then you have a change of character. Then you have a change of character around here. You have a change of character around here, going higher than the previous candle, and then this is not lower than the previous low. That means we have changed character and we are trying to move towards the uptrend. And you can see now, you can see a high, a higher low, a higher high, a higher low, and then you have it. So what is important is that you need to quickly spot that indication so that you can enter before it starts, or as it's starting, for you to what? Get a whole, for you to get enough pips in the markets. So you can see what we have here. It is important to understand what the market is trying to do. This is another kind of bullish candlestick pattern where you have an hammer at the bottom of the pattern, pushing, giving you potential to change direction to the upper side. Okay, so this is called an hammer, and then hammer candlestick pattern is formed with a short body and a long lower wick, and is found at the bottom of the downward trend. So you have to look at it properly. And for those that will be looking at it at a lower time frame, you are not doing it well. So I will tell you, go to the higher time frame. I will recommend H4 for you. When you see a trend on the H4 and then you're seeing the hammer there, then that is indicating the uptrend. Meanwhile, also you study what's going on in the market, and you also try to look at the repetition that the market is doing to get in at the premium zone. So now a hammer shows that although there are selling pressures during the day, ultimately a strong buying pressure drove the market back up. The color of the body can vary, but green hammers indicate a strong bullish market rather than red hammers. Here we have inverse hammer. This is an inverse hammer. You can see that the wick is on top rather than the one that is below, and the body is just showing you the same small body. Now, this is a similar bullish pattern in the inverted hammer. A similar bullish pattern is the inverted hammer. The only difference is that the upper wick is long while the lower wick is short. This indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market down. The inverse hammer suggests that buyers will soon have control of the market. The next one that we are looking at is bullish engulfing. What I want you to notice here is that these hammers get their name from their behavior. You can see a smaller candle in the circle and a bigger one in the circle as well, that the bigger one engulfs the smaller one. So that's why the name comes engulfing candle. So you call it bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is short red body that is completely engulfed by a larger green candle. Though the second day opens, now we are imagining that the first candle is a day candle, second candle is a day candle, so we are on a daily time frame. So that's why I will assume that though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. So now let's look at the next candle, which is the piercing line. Okay, the piercing line is also a two-stick pattern made up of a long red candle followed by a long green candle. There's usually a significant gap. There's usually a significant gap there's usually a significant gap between the first candle's closing price and the green candle's opening. It indicates a strong buying pressure as the price is pushed up to or above the mid price of the previous day. The next on the candlestick on the bullish candlestick pattern is the morning star. The next on the bullish candlestick pattern is the morning star. You can see it, as the name suggests, it comes down here. You can let us fix our eyes. Let us fix our gaze at the circle, okay, and see how a morning star is formed. As you can see here, a big red candle comes down here, and a small candle comes here, more or less like a doji, and then the next one you have a bullish candle. So this is a morning star. So when you see something like this on a higher time frame, know that the next candle will indicate your entry point, and then you keep going in as a buy. You can make this point here as your entry point, while you make this point here as your stop loss. So how do you really describe this candle? The morning star candle is considered as a sign of hope in the blink market downtrend. It is a three stick pattern, one short bodied candle between a long red and a long green candle. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the seller's pressure of the day is subsiding and a bull market is on the horizon. The next but not the least, the next bullish candlestick pattern, but not the least, is the three white soldier, or also called three green soldiers. Now, these three white soldiers pattern occurs over 3 days. It consists of consecutive long green or white candles with small wicks, which open and close progressively higher than the previous day. It's a very strong bullish signals that occurs after a downward trend and show a steady advance of bullish pressure and shows a steady advance of buying pressure. Now we move to bearish candlestick pattern. Now you can see this Bitcoin chart that the story is trying to tell us that it is bullish here, and it gets to this point, and what do we see now? We see that it's returning down. Here it's being rejected, it goes up, back, rejected, goes up, back, rejected, goes up, rejected almost 3 times, and then what do you notice? That is a resistance, and that resistance now pushes it down, and then you have what? You have bearish candlestick pattern. So the first, you have bearish candlestick pattern. So bearish candlestick patterns usually form after an uptrend just like this and signals a point of resistance. Heavy pessimism about the market price often cause traders to close their long positions and open short position to take advantage of the falling prices. So now let's look at 6 bearish candlestick patterns. First one is the hanging man. You can see the hanging man here. It's just the opposite of the hammer, because most hanging men are actually red, and then you find them in an uptrend, signaling a reversal to the downward trend. So a hanging man is a bearish equivalent of an hammer. Just like I said, it has the same shape, but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but that buyers were able to push the price up. The large sell-off is often seen as an indication that the bulls are losing control of the market. The next one is the shooting star. Okay, now the shooting star is the same shape of the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper wick. Usually, the market will gap significantly. Usually, the market will gap slightly higher or on opening and rally to an intraday high before closing at a price just above the open, like a falling star to the ground, like a star falling to the ground. So what this tells us is that when you're looking at these characters, look at them on the higher time frame, because if you go to a lower time frame like 1 minute, 2 minutes, or 5 minutes, all these things would not hold because those ones are weak levels. So when you look at these things on a high time frame, now we are referring to a previous day, so that's or intraday. So that's to tell you that a whole candle here can signal a whole day or half a day. So you need to work at looking at your candle on a higher time frame. Don't be in a hurry. When you see these things happen at a high time frame and you go in, you are sure that your analysis is very correct. You are sure that your analysis is on. You are sure that your analysis is absolute. You are sure that your analysis is near absolute. The next, but not the least, is the bearish engulfing. It's just a bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It's just an opposite description of the bullish engulfing. So this signals a peak or slowdown of price movements and is a sign of an impending market turn down. It's a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. The next is the evening star. We have looked at the morning star. The next is the evening star. We have looked at the morning star and saw that it indicates a uptrend. Likewise, or otherwise, the evening star indicates a downtrend, starting with an uptrend, and then gives you something like a doji, and then comes the what? The downward trend. So when you see the bearish candle comes up, the level of which it comes tells you how long the downtrend will last. An evening star indicates the reversal of an uptrend and is particularly strong when the third candle erases the gains of the first candle. The next is the black arrows. The next is the three black crows. These are also the opposite of the three white candles, the three white soldiers. So the three black crows candlestick patterns comprises of three consecutive long red candles with short or non-existing wicks. Each section opens at a similar price to the previous day, but selling pressure pushes the price lower and lower with each close. Traders interpret this pattern as the start of a bearish trend as the sellers have overtaken the buyers during three successive trading days. The next is the dark cloud cover. We can see how the dark cloud covers plays out. It covers candlestick pattern. These candlestick patterns indicate a bearish reversal. A black cloud over the previous day's optimism. It comprises of two candlesticks, a red candlestick which opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wick of the candles are short, it suggests that the downtrend was extremely decisive. So next, let's look at continuation candlestick patterns. If a candlestick pattern does not indicate change in market direction, it is known as a continuation pattern. This can help traders to identify a period of rest in the markets when there is market indecision or neutral movement of price. There are at least 4 continuation candlestick pattern you should know: Doji, spinning top, falling 3 methods, and rising 3 methods. We'll look at them one after the other. Here is a doji. You can see how a doji looks like. We've shown you before, but when you keep seeing a doji like this, it indicates continuation. When the markets opens and close are almost at the same price points, the candlestick resembles a cross or a plus sign. Traders should look out for a short to non-existent body. Traders should look out for a short to non-existent body with wicks of varying lengths to identify a doji. This doji's pattern conveys a struggle between buyers and sellers that results in a no net gain for either side. Alone, a doji is a neutral signal, but it can be found in reversal patterns such as the bullish morning star or the bearish evening star. The next is the spinning top. The spinning top candlestick pattern has a short body centered between the wicks of equal lengths. The pattern indicates indecision in the markets, resulting in no meaningful change in price. The bulls sent the price higher, while the bears pushed it lower again. Spinning tops are often interpreted as a period of consolidation or rest following a significant upward trend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies the current market pressure is losing control. The next on the list is the falling 3 methods. 3 method formation patterns are used to predict the continuation of a current trend, be it bearish or bullish. The bearish pattern is called the falling 3 methods. It is formed of a long red body followed by 3 small green bodies, and another red body. The green candles are all contained within the range of bearish bodies. It shows traders that the bull do not have enough strength to reverse the trend. The opposite is true for bullish patterns called the rising three methods. The rising three methods candlestick pattern. It comprises of three short reds sandwiched within the range of two long grains. The pattern shows traders that despite some selling pressure, buyers are retaining control of the markets. Next is reversal candlestick patterns. So we want to look at doji patterns and how to interpret them during reversal. We want to look at doji patterns and how to interpret them during reversal. You can see a doji here in the upper part of the candlestick pattern, and then you can see that it indicates reversal because the market was actually going what? Upward direction. But after a doji comes, the market begins to drop. Then at this point also, when it gets to this level, you see we have a long leg doji here, and then another point here and here signals that the market could reverse even is a little, and this little can be as much as 100 or 200 pips. And when it gets here again, a doji appears again, and then the market begins to fall. So dojis indicates reversal. So we look out for dojis on high time frame. Once we see them, and then we can begin to anticipate a reversal. One candlestick pattern. We talk about under this. We talk about under this reversal candlestick pattern. We want to talk about an hammer, which also indicates one candlestick pattern. These are bullish reversals when you find them on the bottom of the charts. And we also have the hanging man, also indicating reversal, bearish reversal when you find them at the top of the charts. Then we have this shooting star. Like we have said before, a shooting star comes up as a one candlestick pattern at the top of the charts. And then we have a mariboso. A mariboso could either be a red mariboso or a green mariboso. When it's a red mariboso, that's a bearish chart. That's a bearish candlestick pattern. But when it's a green mariboso, that's a bullish, that is showing a bullish trend. Now let's see how that one candlestick pattern can also be applied on these charts. You can see the hammer here, and you can see what we have. This is a chart of what has played out in the past. And then we notice that this candlestick pattern are already playing out here. You can see the hanging man indicating the falling pressure. And then here also, we have a sort of an hammer here going up. And then here we have shooting star coming down. So it is important to identify this candlestick pattern so that you can be able to have a grip of your technical analysis. Now we move to two candlestick pattern. We have the bullish engulfing and the bearish engulfing. So this is the dark cloud cover, and this is the piercing pattern for two candlestick pattern. Here we have for two candlestick pattern. Here we have the engulfing and the dark cloud pattern. What does that mean? When we have engulfing, that suggests that the candle following the previous candle covers it. You can see that this candle covers the previous candle. So that is more or less like a dark cloud on this candle and also engulfing it. So here we call this dark cloud because it's dark and it's clouding up this candle, going beyond it. You can see we have 1, 2, 3 covers all of this, and then here we have bullish engulfing. The first candle is small and it's white candle, but a bearish candle comes here and engulfs it. So that is what we call the engulfing and the dark cloud pattern. You look out for them in your analysis, and then you'll be able to do something sweet as you make the right trading decision. So I want to leave you with this candlestick sheets. So this will help you to summarize all the things you have been talking about, to identify them one by one. Okay, if it's for a refresher course, please keep these sheets to your chest or in your library or in your diary, and make sure you are able to identify them. You can draw them. You know where they are formed, and you know what they do, and you know what they also indicates. It's very important whether you are a refresher, whether you are doing as a refresher course or you are doing this course for the first time. Make sure that this cheat sheet is not far from you. Thank you for your attention. Kindly subscribe to the channel, Chart Patterns. Sign up with our links, and then you can get $100,000 demo accounts for learning. You can also get your 100% deposit bonus for your live account with our promo code. Visit our website and follow us on our Instagram page. Here are some few questions that you may want to look up so you can test your knowledge on technical analysis. Thank you, and see you again.